Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Welcome to the Deep Dive. We take complex sources, break them down, and give you the knowledge you need. Today we're tackling something that, well, it puzzles a lot of people. Investors, the public, politicians too. How do these huge profitable companies, you know the names, Apple, Amazon, Starbucks, how do they report billions in profit but seem to pay surprisingly little in tax sometimes? So our mission today isn't about judgment. It's about understanding. We want to pull back the curtain on corporate tax strategy. Forget tax evasion. For now, we're focusing on legal optimization, how finance teams use incentives, credits, global structures, all perfectly legally, to shrink their tax bills.
And that's really vital knowledge for you, especially if you work in finance or analyze companies. Understanding this optimization means seeing taxes not just as a cost, but as something, well, manageable, a strategic cash outflow. We need to see where smart planning starts and, crucially, where it bumps up against public opinion and regulatory eyes. I mean, think about it. Taxes are often one of the biggest cash outflows for a company. But what's unique is they can be strategically managed. It's not like raw materials costs. Tax codes have flexibility built in.
Right. So corporate taxation, that's the basic set of rules for taxing company profits. But the real action starts when you define profit for tax purposes, doesn't it? Because a profit on paper, the accounting profit, often looks very different from the taxable profit.
Absolutely. The number one metric every finance chief watches is the effective tax rate, the ETR. That's the actual slice of profit they pay after all the deductions, all the credits, maybe deferring some payments. All that gets factored in, and the goal, it's simple. Legally minimize that ETR to maximize value for shareholders.
And here's the tension, the thing that causes the headlines, I think. When a giant company pulls off a really low ETR, they're usually not breaking the law. They're often using incentives the governments themselves put in the tax code, right?
Precisely. Governments want companies to do certain things, invest in R&D, build factories in certain areas, use clean energy, so they offer tax breaks for it. These aren't loopholes, usually. They're policy tools. A smart finance team just builds these incentives right into their planning. It's like strategic arbitrage using the tax code. Totally legal.
Okay, so let's really get into it. Let's unpack the playbook. If you're a finance team at a big multinational, what are the main levers you pull? Say, the top 5 tools for optimization.
Right. Well, we can start with the ones directly linked to those government policies we just mentioned. First up, tax deductions and credits. This is basically modeling those incentives. So if there's a big R&D tax credit, the finance team needs to track every single dollar spent on research that qualifies. Maximize that credit, that directly lowers the ETR.
Makes sense. And related to that, I suppose, is how they handle big assets, like machinery, buildings. That's depreciation and capital allowances.
Exactly. When a company buys, say, a huge new machine, they deduct the cost over its useful life. But often, the tax rules allow accelerated depreciation, which means you take bigger deductions earlier on.
Ah, so you get the tax saving sooner.
Right. It boosts your cash flow in the short term, even if the total tax saved over the machine's life is the same. It's about timing. Cash today is better than cash tomorrow, isn't it? Okay, now we get into the really complex stuff, especially for companies operating globally, and this is probably the most controversial lever, transfer pricing.
Yeah, let's spend a moment here, because this feels like where a lot of the public scrutiny comes in with companies like Starbucks or Apple. What exactly is transfer pricing? Why is it so tricky?
Okay, so transfer pricing is about the price set for internal trades within a big company group. Imagine the U.S. parent company invents something, owns the patent, the IP. It then licenses that IP to its subsidiary in, say, Ireland. That license needs a price. Or the factory in Singapore sells parts to the sales office in Germany. That sale needs a price too.
And the rule is that price has to be arm's length, right? What unrelated companies would charge each other on the open market?
That's the principle, the arm's length standard. But I mean, how do you put an objective market price on the right to use the Starbucks brand in France? Or a unique bit of software code? It's inherently subjective.
So there's wiggle room.
There's modeling involved, sophisticated modeling. Finance teams work within OECD guidelines to set these prices. The aim legally is often to allocate more costs and thus less profit to subsidiaries in high-tax countries like Germany or the U.S., and conversely, allocate more of the resulting profit to subsidiaries sitting in low-tax countries. It's like a global financial chess game, but played according to very specific rules.
Which brings us neatly to the next lever, using holding structures and low-tax jurisdictions. Because if you use transfer pricing to shift the profit, you need somewhere for it to land, right? Somewhere attractive.
Exactly. Call them tax havens, low tax jurisdictions. Ireland, Luxembourg, Singapore, Switzerland are common examples. The strategy often involves parking high-value assets like the company's brand, its patents, its core IP in a subsidiary based in one of these places. Then, royalties or fees for using that IP flow into that subsidiary from operations worldwide and get taxed at that very low local rate.
But this needs to be done carefully, I imagine.
Oh, absolutely. Transparency and documentation are paramount. If it's done within the rules, it's legal optimization. But if the structure gets too complicated, too opaque, or if that subsidiary in Ireland is just a mailbox with no real employees managing the IP, what they call lacking economic substance, that's when regulators get very interested, might challenge it.
Okay. And the fifth lever, you mentioned one that's become less common.
Yeah, corporate inversions. This was a big one for a while. It's basically the ultimate move changing the company's legal home country. Relocating the headquarters, on paper at least, to a country with a much lower tax rate, often by merging with a smaller foreign company.
Even if most of the actual business, the factories and staff, stay put.
That was the idea. Your operational center might still be in the US, but your legal HQ is now in, say, Ireland, allowing you to manage global profits under Irish rules. But the policy risk here is huge. The U.S. brought in tough anti-inversion rules around 2017 that made this much harder and less beneficial, so you don't see it nearly as much today.
Right. This is where it gets really fascinating, seeing these strategies actually applied by big companies and seeing where that optimization runs into trouble, either with regulators or just public anger.
Let's start with Apple. It's kind of the classic case study for using holding structures and specific tax rulings. For years, Apple used a structure involving Irish subsidiaries. It got quite technical, but one key part was an Irish-registered company that wasn't considered tax resident anywhere for a period.
Wow. So huge amounts of profit generated outside the U.S. flowed through these Irish entities, and they paid very, very little tax on it.
Effectively, yes. A tiny ETR on those massive foreign earnings. They were skillfully navigating the gaps between different countries' tax residency rules, and importantly, the structure complied with Irish law at the time.
But then?
Then the European Commission stepped in. They didn't just challenge the structure itself. They argued that the special tax rulings Apple got from Ireland amounted to illegal state aid, basically an unfair advantage not available to others.
And Apple had to pay back billions.
Eventually, yes, though it's been appealed and fought over for years. The big takeaway for finance teams, though, is you can't just look at the law in one country. What's legal and agreed today might be challenged later as an illegal subsidy, especially by powerful bodies like the EC. You need to think cross-border long-term.
And sometimes the problem isn't even the regulators, it's the customers. Starbucks in the UK is a prime example of reputational risk, isn't it?
Absolutely. Starbucks faced huge criticism in the UK because they were reporting significant sales but paying almost no corporation tax.
Why do they manage that?
Classic transfer pricing, essentially. Their UK coffee shops paid really large royalty fees to another Starbucks company based in the Netherlands for using the brand and the coffee know-how, the IP. So these massive internal royalty payments wiped out most of the profit in the UK, a high-tax country, and shifted it to the Netherlands, which had a favorable tax regime for that kind of income. Perfectly legal under the tax treaties at the time.
But the public hated it.
They really did. There were boycotts, protests. The backlash was so intense that Starbucks eventually announced they would voluntarily pay more UK tax than legally required, just to try and repair the brand damage.
That's incredible. It shows that financial optimization has to consider brand value now. The potential hit to your reputation can outweigh the tax hit.
Definitely. And look at Pfizer for political risk. They announced this huge merger with Allergan, an Irish company. It was explicitly designed as a corporate inversion to slash their global tax rate by moving the HQ, on paper, to Ireland.
A textbook inversion move.
Textbook, but it was high profile and politically sensitive. The U.S. Treasury, facing pressure, rushed out new regulations specifically designed to block that type of inversion deal. And just like that, Pfizer's multi-billion-dollar strategy was dead in the water, killed by a change in administrative rules. It shows how quickly policy can shift and just wreck financial models built on the old rules.
Okay, one more Amazon. They often face scrutiny too, but their approach seems a bit different, more about deductions.
Amazon's strategy is often more about maximizing those deductions we talked about earlier, like R&D credits, and also clever use of accounting and geography. For instance, they might book big operating cost marketing, logistics in high-tax countries where the activity happens, like Germany, but the profit often linked to their intellectual property or platform services, gets recognized in lower tax jurisdictions like Luxembourg. They also make significant use of deferred tax assets, basically, booking tax benefits now that relate to future profits or past losses. It's all quite complex, but the result is often an ETR significantly below the standard corporate rate. And the key for them is making sure how they report this geographically lines up with their tax positions.
So pulling this all together, for you, the finance professional, maybe a future CFO listening to this, how do you navigate this? It sounds like a real tightrope walk. You've got efficiency goals, compliance rules, political heat, public perception. What's the modern mandate for tax planning?
Well, the mindset has definitely shifted. Tax isn't just a back office compliance job anymore. It's become a strategic function. It involves risk management, forecasting global policy. It's much broader.
And are there guiding principles for doing this responsibly?
I think we can boil it down to a few key things. Firstly, you absolutely must align tax strategy with the business strategy. Tax savings can't dictate how you run the company. If you set up a complicated structure, say involving IP in a low-tax country, purely for tax reasons, and there's no real business activity or substance there, that's a huge red flag for auditors. The tax structure has to support the real business.
Okay, align with the business. What else?
Secondly, and this is crucial internally, forecast cash taxes, not just accounting taxes. The tax number on the profit and loss statement, the accounting expense, is often different from the actual cash walking out the door to the tax authorities in a given year. Finance teams have to track both, understand those timing differences, because cash flow impacts everything: liquidity, company valuation, planning.
Right, cash is king. Knowing when you actually pay the bill matters hugely.
Third, rigorous documentation of intercompany policies. We talked about transfer pricing being subjective. Your best defense against a challenge is meticulous records. Every internal transaction, every royalty, every service fee between subsidiaries needs a clear, documented reason, the method used to price it, and ideally data showing it's comparable to arm's-length market rates. Transparency protects you.
Okay, alignment, cash focus, documentation. Anything else?
Yes, the fourth and maybe the newest imperative. Monitor global regulatory trends. Tax teams now have to work much more closely with legal, even with ESG teams, because the global landscape is shifting under our feet.
You mean things like BEPS and this push for ESG reporting? How do they change the game?
Massively. Let's take BEPS first. That's the Base Erosion and Profit Shifting Project led by the OECD. It's a huge international effort basically designed to stop companies from shifting profits to zero or very low tax places where they don't have much real activity.
How does it do that?
One key part is pushing for a global minimum corporate tax rate, currently aimed at 15% for large multinationals. The idea is if a company manages to pay only, say, 5% tax in country A, its home country, or another country in the group, could potentially collect the extra 10% top-up tax.
So it directly undermines the benefit of those super low-tax jurisdictions we discussed, if you have to pay 15% anyway somewhere.
Exactly. It fundamentally changes the incentive structure for locating profits. It forces much greater global transparency, too. It completely upends the kind of modeling that worked 10 years ago.
And ESG. How does environment social governance reporting connect to tax?
Well, the social aspect increasingly includes tax. Major investors, pension funds, the public, they want to know how much tax companies are paying, where they're paying it. They see it as part of being a responsible corporate citizen. So companies are under pressure to be more transparent about their tax contributions. It pushes tax strategy out of the purely financial realm and into the public square, much like we saw with Starbucks. Tax is becoming part of the corporate social responsibility narrative.
So we've taken quite a deep dive here. We've gone from basic incentives and credits all the way through complex global structures like transfer pricing and holding companies. We've seen how legal optimization works, but also how it can clash with regulators and public opinion.
And understanding how to build these structures so they're efficient, but also resilient to BEPS, to regulatory challenges like the EC threw at Apple, to public scrutiny. That's the real skill now. It requires a level of foresight, of global awareness that maybe wasn't needed quite as much a generation ago.
It definitely feels like the ground is shifting. Corporate tax strategy isn't just about technical rules anymore. It's about global policy, predicting change, and managing massive reputational stakes.
So here's a final thought for you to consider. If this is the new reality, if tax teams need to be experts not just on, say, transfer pricing documentation, but also on forecasting huge global shifts like BEPS and handling the rising tide of ESG transparency, how fundamentally does the required skill set for a successful corporate finance professional need to change over the next 5 years? What new capabilities will be essential? It's something worth thinking about for your own career path.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.